Hello, everyone. Welcome to Building Your Financial Future. We are so happy to have you here with us. My name is Diana Zhao, and I'm one of your co hosts today. And I've been in the financial industry for over a decade, helping clients throughout their financial future from any point of their lives. But before I introduce my amazing co host here with me, a couple of housekeeping things to go over. For those of you who are receiving wellness points, there will be a survey at the end of today's presentation, and your employee passphrase is strong woman. Just because of our topic, we thought it would be fitting that today's passphrase is strong woman. And then also for next month, the next wellness show will be July 16th at 12 p.m. Eastern Time. And with that, I will turn it over to Angela.
Thank you very much. I am so happy to be co hosting with you today. And it's such a great topic. We are going to talk about how our finances are affected for us as women. So, thank you
Mhm.
so much for being here. I am Angela Nieves, and I've been with the financial industry for the last 3 decades. And I've been traveling all over the United States helping people plan for retirement, take advantage of financial wellness, and all that good stuff. So, happy to be here. And with that, let's begin with asking you all the most important question, right?
Yes.
What do you think? What is the most important thing that you're going to be doing during your retirement, right? What would you like to do during your retirement time frame? And when I ask that question, what do you see? Do you see yourself traveling to places
Mhm.
on your bucket list? Do you
Mhm.
plan on taking on your hobbies? Maybe spending time with family and friends? Maybe you'll work part time. Maybe you'll volunteer. But the reason why I ask is the way you see what your retirement is going to be like is going to dictate how much money you're going to need to get there. And with that, I know as women we have challenges. So I'm going to bring Diane to talk about what challenges do we face as women?
And that's a really good point. Thank you so much, Angela. With this topic of women in retirement, it is important to not only talk about, yeah, what do we want to do in our retirement years and what that could look like for us, whether it is traveling or having fun, but in the same time, we also have to talk about specifically for women, we do face challenges as we are trying to get to that point. Now, a couple of them will happen early on in your lifetime, throughout your lifetime, and then later on in your lifetime. One, we live longer than men. Now, some folks might say that's not necessarily a challenge, maybe more of a privilege, which I completely understand. I agree. But the thing with living longer and having longer life expectancies is we are going to have higher healthcare costs in retirement. As we get older, the bones get brittle, and we just got to face what comes ahead. And because of that, because we live longer, we're more likely to live on our own during those retirement years. Now, again, that could be a positive, right? That can be more privilege than a negative, but that's just something also to keep in mind. Now, a big one here is our fourth bullet point that says we're more likely to be the caretaker of our family. So we'll either take career breaks or adjust our careers, whether taking care of kids, taking care of parents, loved ones. Women are more likely and just historically have done that, which that could then interfere with the plans that you have for the future. And then one that we all know that's been always talked about is women tend to earn less than men. Now, what we're seeing lately is that women who work a full time job on average earn about 83% to men. Now, we have been seeing progress in this portion, which has been nice to see, but we know it exists and it's out there. And we still want to act with what we can do when we're thinking about retirement. And some of the answers that are coming in here about spending time with family, traveling being a big one, not working, right? So we want to talk about that. And to do that, we have to look at our next slide where we talk about how much income will we need for some of these things we're planning ahead. And this is a really big question to ask yourself. How much income will you need for your retirement? Now, of course, that is sort of kind of like guesswork because we don't know, but there's some guidelines we can talk about. The first one being, most of us will generally need roughly about 60 to 90% of the current income we have right now. Now, if you stop and think about it for a second, right now you're not living off of 100% of your income, right? Some money is going towards Social Security, through taxes and also Medicare, and then other dollars are going towards, saving for retirement. And then the remainder of what you're getting, you're living off that, so it's already not 100%. So just to give you a little bit of relief to think about that notion of how much you'll need in retirement. And then I'm going to, switch these bullet points here, but I'll cover it all. We want to think about our budget, what our expenses are going to look like, right? What will change now compared into retirement? Because some of these things are going to change when you're looking to that 60 to 90%. For example, hopefully by the time you get to retirement, the mortgage is paid off. That's a big one for most of us. Hopefully the kids are out of the house as well, right? But one thing we know that's going to go up, I talked about it earlier, healthcare. Whether it's you and your spouse together at home or it's just going to be you, healthcare costs just go up in retirement. And then the fun things that we started with our poll question, right? What do we want to do? We want to have money for the things we want to do, the travel, the hobbies, because that's going to give us a fulfilling retirement. And then, to be honest, that's what's today's conversation about, making sure we have a fulfilling retirement. And then going back to that budgeting notion, your budget is going to adjust throughout your lifetime. That's naturally going to happen because you've already experienced it from when you started budgeting till now, from when you had your first job to now. We have always seen changes in our budget. So keep looking at your budget, and as it evolves with you, keep making changes as you're going along. And then two more things we want to consider for our retirement is something we're already experiencing right now. And they're not fun topics, but we cover them because it's really, really helpful to just get an understanding what we are doing now and maybe what could happen in the future. Now, I'm going to start with inflation and then go to taxes, because inflation has been a topic since about 2020, right? When COVID started. It's been in the news and we've experienced really high inflation. Things have come down since then. But historically speaking, average annual inflation has been about a rate of 3%. And then just to tell you, inflation is the cost of things, right? Everyday goods, when you go to the grocery store, when you get gas, when you buy clothes, all of that. What we have seen throughout history, it stayed roughly about the average is 3%. And what that sort of could mean to you, to put it into terms, and I have an example here, is at this rate, prices double roughly about every 20 years or so. So in the example, it says there, assuming a 3% inflation, something that costs $50,000 today, in about 20, 25 years or so, it's going to cost $100,000. Now, the hope is we're saving, putting money away for that retirement to get there, so then we can account for costs for later. If I asked you what your favorite thing was to buy 20, 25 years ago compared to the price now, even of milk, we know we've seen the price go up throughout time. So these things happen. So keep inflation in mind as you're going along and you're looking at things. The other part that's a big one is taxes. When it comes to taxes, we sort of break it down in different categories. The first one, ordinary income tax. That's the tax brackets you always hear and talk about. When someone goes, what tax bracket are you in? You can go, well, I think I'm in the 22% tax bracket or the 24% tax bracket. But we know if you go to irs.gov, our tax system is a tiered system, right? Not all your income is going to be taxed at 22%. It's a broken down portion, right? The first, let's say 12,000 will be taxed at 10%, then the next portion will be 12%, and it breaks down that way. That we don't know what's going to happen in the future with how taxes are going to equate and what's going to be looking like, but we know ordinary income, your tax bracket, will always apply. Now, another thing you can do as you're looking at your taxes is when you're saving and investing and you have taxable accounts, like a brokerage account, whether it's an individual or a joint account, There are what known as special tax rates or reduced tax rates when it comes to long-term capital gains and qualified dividends. A long-term capital gain, what that means is if you have an investment that you've invested in more than a year, any of your capital gains that you receive, those the money coming in and the qualified dividends coming in, will have a lower tax rate compared to your ordinary income tax bracket. And the highest right now it goes is about 20% for those in the higher tax brackets. So then, if you ever needed to, let's say, sell an investment, you would have that lower tax bracket when you use that, whether now or in retirement. Next portion from there, still talking about taxable types of accounts, you have tax free income. And this usually comes in the form of bonds or municipal bond funds, where when you invest in these, the interest that you receive, it could be federal, maybe even your state, if they're issued from your state, where the interest you receive, it comes out tax free for you. So that's another option that can help alleviate taxes now or maybe even for your retirement. And then the last one, this is a big one because we're all utilizing this maybe one way or another. The specials for tax advantage accounts. These are your retirement type of accounts, your 401ks, 403bs through work, IRAs, whether it's traditional or Roth IRAs. There's some sort of tax benefit you get, whether you get a tax break ahead of time or you're going to get a tax break in retirement, depending on how you're making your contributions. You have some tax advantages there. And as your money is growing throughout the years, you're not paying any taxes on that amount at that time. And so that's just a little bit start to our conversation here. I'm going to quickly check for questions. I'm not seeing anything come in, but let's continue. And Angela, I do have a question for you asking, well, when we're thinking about our retirement, how long will our retirement last?
And that is such a great question because we are living longer lives and we need to know exactly what our retirement income needs are going to be and how long the money needs to last us. And when it comes to your retirement, right, that is the biggest question. It is an unknown. How long are we approximately going to live in our retirement years, right? We can look at our parents and grandparents and see how long they have lived, right?
Yeah.
But I have some good news for everyone. We are living longer lives. And the bad news is that we're living longer lives. And so our money has to last for a longer period of time. The average 65-year-old woman can expect to live to the age of 85 years or more. That's a long time. And we need to plan for what's ahead. And life expectancy has increased over the years, right? We are living longer lives because we're taking better care of ourselves, right? We are watching our health, we are doing exercise, and we're just taking care of our body. So we're living longer lives. So we need to plan for a retirement that's going to last between 25 to 30 years, which means your income and savings will need to last that long as well. So we need to plan for what's ahead, right? And again, yes, we can think of our hobbies and things we're going to do when we get there, but we need to think of how long we're going to live. And then the next question is going to be, where will that income come from during our retirement years? Now, traditionally, retirement income has been described as the three pillars of retirement income. And those three pillars are composed of Social Security, which provide us a stream of monthly income for the rest of our lives once we retire. There are pensions and annuities, which also provide us with a fixed stream of monthly income. And then there are retirement savings. And I know Diana alluded to these 401ks, 403bs, individual retirement accounts, and so forth. So that's what makes up those three pillars. And we're going to talk about each of those pillars closely because we want everybody to walk out here with knowledge. Now, let's take a look at the first pillar, which is Social Security. And today, 94% of US workers are covered by Social Security. Yes, and Social Security is the major source of guaranteed lifetime retirement income for most Americans. Now, for some women, Social Security makes up the most, if not all, of their retirement income. Now, to qualify for Social Security benefits, You have to work a job that is covered by Social Security. You have to earn 40 credits, which is 10 years worth of work. And if you haven't worked that long, you may not need to qualify on your own. Maybe you can qualify on your spousal benefit, which equals about 50% of your primary earner's benefit. So yes, if I haven't worked, maybe I'm a stay-at-home mom, I can qualify on my husband's work or spouse's work history. And where do I get those numbers that are applicable to me? Well, you're going to go to SSA.gov. So that's Social Security Administration.gov. That website is going to give you exactly what you're going to receive at certain years in your retirement. Now, Social Security statements used to be mailed to our home addresses, but they
Mhm.
stopped doing that, I would say, about 10 years ago. So we
Mhm.
need to become a member of that Social Security Administration.gov website to download your statement, which is available February 1st of every year. And it's going to tell you exactly what you get on your work history or on your spouse's history. But it's important to look at that statement. Now, when we look at what amount you're going to receive from Social Security, that's going to be based on the number of years that you worked and the amount that you have earned, right? They're going to do that calculation for you. Your benefit is calculated using a formula that takes under account the 35 highest earning years. And if you earned little or nothing in those years, you may be it may be to your advantage maybe to work a little longer so that you can have the opportunity to replace a lower earning year with a higher earning year and potentially result in a higher retirement benefit. Now, Social Security annual cost of living increases are calculated every year. So every year that you get your benefit, they're going to calculate your cost of living, which will give you that increase, and it's going to be based on your based benefit. So the higher you start your benefit, the more potential for higher increases for the cost of living. Now, if you are married and your lifetime earnings were lower than your spouse's, you may be eligible for spousal benefit, which means that they're going to give you whatever amount is bigger, whether is 50% of your spousal benefit, or if your own work history gives you that bigger amount, Social Security is going to provide whatever is biggest. And again, get that Social Security statement so you can read how those numbers are applicable to you. Now, an unmarried divorced spouse who was married for at least 10 years may also be eligible for spousal benefits. And again, read up on that information on that website. Now, the age at which you start claiming your benefits will also affect the amount you'll receive. If you claim your benefits at age 62, right, you're going to receive about 70% on average worth of your benefit. So you're going to have your benefit reduced by 25 to 30% just because you started early. Okay, that's called early retirement at the age of 62. And keep in mind, too, that if you retire at the age of 62, you're not going to have medical benefits until age 65 when Medicare kicks in. So that's something to consider if you're going to consider early retirement. On the other hand, you'll receive a higher monthly benefit if you retired at full retirement age, which is 100% of your benefit. And full retirement age could be 66 or 67. And it depends on the year that you were born. If you were born before 1960, that's 66 years old. And if you were born after 1960, full retirement age is 67. And that's when you get 100% of your benefit. Now, you can also get a higher monthly benefit if you delay receiving Social Security until age 70. And at that point, they're going to add 8% each year that you delay your benefit until you get to age 70. Now, a couple of things to consider. Yes, if you retire at the age of 62, yes, you're going to get smaller checks, but in the end, you end up receiving more checks, right? If I retire at 62 and my full retirement age is 66 or 67, well, that could mean that I could get an average of 48 additional payments, right? So it's something to consider. When you sit down and you plan, think about the age, Think about the checks, look at that Social Security statement to see what is best for me at any particular age that I decide to retire, whether 62, 67, or 70, right? So much to learn about, but I'm glad we're having this conversation because I want to illustrate a hypothetical. And this is a person that's going to receive or claim Social Security benefit at different ages and is based on a full retirement age of 66 and a benefit of $1,800 a month. Now, if you start taking your benefit at age 62, right? Remember, you're going to have a reduction between 25 to 30%. So your check is going to be approximately $1,350 a month. If you wait until age 70, you'll receive $2,376 a month. And that's about a difference of about $1,000. Now, remember that this monthly payment is guaranteed every month for as long as you live. So you need to make a decision that best applies for you. Now, also another important question as you approach 60 is, should I take my benefit at 62 and receive smaller payments for the longer period of time? Well, that's something to think about. Or should I get a bigger check for a smaller amount of time? It's a very individual decision, but it's a decision that must be made carefully because there's no right or wrong answer. It's very individual. The bottom line, though, is that for most women, Social Security alone isn't going to provide enough income to keep the same standard of living. And
Mhm.
that's a key fact. We all have a standard. We're accustomed to certain things. And if we depend on Social Security alone, we're going to hurt ourselves. So that's why it's so important to think about other sources of income. And that brings me to take a look at some questions. I don't see any questions coming in. So, Diana, we're going to proceed because I wanted you to talk to us about pensions as the second pillar of our three pillar retirement income.
Thank you so much for that. I did see a couple of questions come in. If you have a second to answer those,
Yes.
um, there were two that were pretty similar, where they were asking about for those who are younger, should they consider what should they think about when it comes to what if Social Security isn't there when they retire, about maybe how to save more for their retirement?
I always say that the key for starting your careers for career starters is to please start saving in a retirement savings plan at work or an individual retirement account as soon as possible. Keep an eye on your Social Security statement for any changes in the law, right? That's key number one. So again, save as much as you can. Take full advantage of a company sponsored 401k or 403b plan or retirement account. And if you're not working, look into individual retirement accounts to save at that point. Let's see.
That's a good point. And then we'll do one more and then we'll keep going. Those one more asking, you talked about, are those 10 years needing to qualify consecutive or can they be broken up over time?
They can be broken up over time. So let's say in your younger years, you work for 3 or 4 years, you got married, you stopped, you raised your children, you got back into the workforce. They're going to calculate the best 35 years, right? That 35 highest years, and they're going to include your work history as a total. So it doesn't matter if you do them all consecutively or if you break it down in little chunks. Maybe you work for full time when you were younger and then cut yourself down to part time and stop for a little while and got back to the workforce. Remember, your Social Security statement is going to tell you how much you're going to receive and how many years you've accumulated. So the Social Security statement is so important, Diana.
I very much agree. It's 10 out of 10, and I will continue into the topic here. So please definitely go to socialsecurity.gov to get your statement and know what you're doing. Now, when it comes to the second pillar, and this second pillar is a little bit more unique. And the reason why we like to talk about this second pillar is that if you looked at our little building structure, if you took out the second pillar, the building would still stand, right? What you're doing could still work if this section does not necessarily apply to you. But it's a great in case for those it does apply to. Where we're talking about pensions and annuities. Now, with pensions, that comes from your employer depending on your occupation. Common ones is if you're a teacher, maybe if you work at a hospital as a nurse or a doctor, you may have the option to get a pension. And then an annuity is something any of us can purchase. Now, this is an insurance product where you would have to buy the annuity. You'd put your money down and you can decide how much you want to put in to then get money from that. What you want to consider two very important things: how much you're going to get when it comes to income, because that's what we're talking about here. With your payouts for an annuity or a pension, are you doing a single life? So it's just based on you and how much your payments are going to be receiving just for yourself. Or are you going to add what's known sometimes as a rider, where you're going to look at a joint survivor benefit that if you were to pass, your surviving spouse would also continue to receive payments. Now, very important thing that's different from Social Security when it comes to a pension or an annuity is that the regular payments that you get every month do not adjust for inflation, where with Social Security, it does adjust for inflation. So if you're supposed to get $500 a month or $1,000 a month, that's it. That's what you're going to get. You can't call up the pension or annuity place and say, hey, can I have more money this month because things are a little bit tough? Because it's supposed to last a certain time frame of what you do when you set up the annuity or what the pension dictates at that point in time. So keep that in mind if this is something that you want to do, so then you are mindful about how much income you have. So when you're looking at your guaranteed sources, and we'll go on to the next slide here, because your pension annuity, just like your Social Security, Angela said, are guaranteed sources of income, because you're supposed to get a certain amount until it keeps going. With Social Security, you can't outlive it. With pension and an annuity, you're going to get a certain amount every month. So then we look at, what if I have a gap? Let's say I need $5,000 for the month every month, and I'm getting $2,000 from Social Security, $1,000 from my pension or annuity. Then there's $3,000 you have to figure out where that money is going to come from. And when you're thinking about that portion, this gap here is really important to first, let's talk about some factors that when it comes to women are really important to discuss of what things can look like for us on the next slide here. Now, for us as women, we have to be mindful that because we earn less than our male counterparts, we sometimes tend to work part-time if we're going to be caretakers, right? So these are factors that maybe work against us when we're looking at, okay, I need to save for those years in retirement to cover any gap that I may have with what we're talking about. And another thing, we start to save later, and we might save a little bit less because if we have kids, we usually account for the kids and money that's coming out for them, and we work fewer years in our workforce. And with these affecting us, we have to be more proactive with how we're looking at, okay, what is my last option with what I have put away that we can use? And for that, I'm going to turn it back to Angela to give us more about what we have available to us.
Thank you so much. And I do want to answer a couple questions, Diana. If you,
Mhm.
especially if you declare Social Security at the age of 62, I want to be clear that if you declare your receiving benefits at the age of 62 and you're going to get that smaller check, that's going to be a smaller check for the rest of your life. So it doesn't go up even when you reach full retirement age. So keep that in mind. And that information, again, is available on your Social Security statement. When it comes to, I know that pension plans are not very common nowadays, and people are asking for other ways to save for retirement if we are no longer qualifying for pensions. And that's what we're going to talk about right now, because it's so important to keep this conversation going. Because with all the challenges that women face, what can we do? First, and the number one thing is start saving now for retirement. Whether you're going to be saving through your employer plan, whether you're going to be saving through an individual retirement account, and set up a savings goal that you can work towards too. If you are, again, if you, as Diana explained, if I have $3,000 coming from Social Security, $1,000 coming from a pension. I need to come up with the rest. Yeah, set that up as a goal, right? You can also use financial professionals that can help you figure that out. If your employer offers a retirement savings plan, such as your 401k, 403bs, start contributing as much as you can. Contribute the amount um, to get you, because in many cases, your employer may offer a company match. Will save enough to get the full company match because that's certainly free money. But it's important to become knowledgeable about uh, and be saving for retirement means that you're an investor. You need to educate yourself on the plans, what they offer for me, what is the best option for me to get involved in saving for my retirement and taking the reins, especially if I'm just receiving Social Security and I don't have a pension because I'm a career starter. I'm young. Pensions are not being offered at my job anymore. So it's something to think about. But currently, get involved in your workforce savings plan. Now, some of you here today have handled family finances along the way, while others are new to investing. And no matter what your level of expertise is, there's always room to learn and adjust your plan accordingly and utilize the tools and resources available in your retirement plans website. Everybody, an employer has a website that you enroll in, a website that you can track your progress. That same website has tools and resources to help you navigate your retirement income, and it'll help you establish a retirement savings goal. It'll account too for Social Security. So it'll say, hey, this is how much you come from Social Security. This is how much you need to save so that you can get to the comfortable retirement.
Mhm.
Become an educated investor. Take classes when they are offered. And I know there are more classes coming up just like this every month. Attend classes. We need to share the knowledge. We need to become experts in investing, experts in calculating our retirement income so that when we get there, we have enough to get to that comfortable retirement. And here's an example of how saving a little extra each month could mean a lot during your retirement years. And we're going to assume Jane and Sally, and they both earn $50,000 a year from their jobs, and they're saving 5%. Let's say Jane saving 5% of her income to her retirement account. Sally, on the other hand, she's saving 8% each month. After 15 years, Jane will have saved 37,500, not too bad, but Sally has saved $60,000, roughly 20 over $22,000 more. Just a 3% difference. And if we look at the investments, because again, retirement accounts are invested and give us potential growth on our money, but let's assume that they've earned 5% per year on their savings. Jane's account would be worth over $55,000 and Sally would have been worth close to 90,000. That's over $33,000 more. And again, when you start saving in your retirement accounts, and I know that sometimes it might be hard to save 5%, 6% out of your pay. Well, start with a small percentage that you're comfortable with. And a lot of retirement accounts, a lot of retirement plans allow you to gradually increase your savings over time, which means I can set up my 401k or 403b or retirement account and set it up to increase me by 1, 2, or 3% a year until I get to 12 or 15%. So save as much as you can. Get used to saving. I know you're going to miss that amount right out of the gate, right out of your paycheck. You're going to see, oh, 3%, but it's gone. It came out of my paycheck. I can do the rest. So save as much as you can and utilize all the resources because your retirement is up to you. And we're going to talk a little bit more about your employer's plans, IRAs, because again, it's probably the best way to accumulate funds for retirement. And it's the biggest advantage because they offer tax deferred retirement saving vehicles, right? When we think about our 401k plans, our employer sponsored 401ks, they're very powerful. Number one, because they give us pre tax savings potential, right? We're going to save our money pre tax. And what does that mean? Pre tax contributions reduce my current taxable and it's going to give me tax deferred growth, meaning I'm not going to pay taxes on my money now. I'm going to pay taxes on my money when I retire on my contributions and potential earnings. But it gave me an actual current tax deduction. Now, withdrawals in many plans could start at 59 and a half. If you take withdrawals before age 59 and a half, there might be penalties that apply. So keep that in mind. Now, having your contributions deducted directly out of your paycheck, first of all, they're easy, they're convenient. It's the idea of paying yourself first, right? The idea of saving before I take my money home and spend it. Well, that works for me. Also, they may offer Roth as an option. And the Roth contribution is the type of contribution where you pay taxes on the contribution up front and that money grows tax free. Find out with your retirement plan if they offer both pre tax and Roth and take advantage of both, right? Which is the best option is a very individual thing, but utilize those resources and tools on your plan's website because they may be calculators that can help you figure out which is your best way to save, whether it's pre tax or Roth. And finally, 401k plans often include an employer match. So save enough to get the full company match because, as I said before, that's free money. Okay. And you don't want to leave free money on the table. So save as much as you can. Now, other ways of saving besides your 401k plan, because a lot of you are asking questions about, hey, I may not have a pension. Are there other vehicles for me to save into? There is. There are traditional Roth and spousal IRAs that can help you save for retirement. They also offer tax advantages, they offer tax deferred earnings, and in many cases, they can lower your taxable income. But if you are going to open a traditional Roth IRA or a spousal IRA, make sure you speak with your tax advisor to see if you can get that taxable, if it can lower your taxable income. Now, like Roth 401ks, Roth IRAs, there's no upfront tax deduction, but the money does grow tax free. So you get tax free withdrawals. Now, all these options, by the way, do offer the catch up contribution. So if anybody that's 50 years plus, remember to take advantage of the catch up contributions, both for employer sponsored retirement plans or traditional IRAs, Roth IRAs, and so forth. And remember that IRAs and 401k plans are subject to annual contribution limits. There's a dollar limit that is involved. Please double check with your plan to see what those limits are that are applicable to you when you save money in your retirement accounts. And again, save as much as you can and take full advantage of the company match if your employer's plan offers that match. And if you're not working, save as much as you can in an individual retirement account. And with that, let's check with Diana with some questions. What's going on out there?
I'm not seeing too many questions come in. We still have some. Oh, I'm sorry. My mouse wasn't sliding here. There are some questions coming in. That was on me here. Now, there was a question asking about saving in your 401k account. And some say, can I do the 401k and then also do an IRA at the same time, or are there limitations there?
You can do them both at the same time, but there are limitations. And the limitations are what can I deduct as, if I'm going to get a taxable income deduction. Okay. And that's when you have to have a conversation with your tax advisor. But you can certainly take advantage of saving in your 401k plans, saving in your individual retirement accounts. But as far as deducting your contribution, that's when you should speak to a tax consultant to verify.
That's a great answer there. I very much agree with that. There was another question, and this is actually a really, really, really good question. It said, there has been a decrease in how much they're receiving from their employer match from work. What should they do about those missing funds that they used to get?
Here's the thing, remember that your retirement is going to happen to you regardless, right? And so if your company is not matching you as much, then you contribute as much. You contribute higher. Get I know that companies are having some issues with company matches. Some of them are being reduced, but that's no reason not to save. Because when you get to retirement 20 years, 25 years from now, I don't want you to find yourself in your retirement day saying to yourself, I wish I could have saved more. And I didn't save more because they weren't matching. Because it is up to us to save as much as you can. So
Mhm.
go above. If they're matching you 2%, 50% on two, well, then you can do six. Just because they're not matching doesn't mean don't save. Save as much as you can because you need to supplement your Social Security with your own savings. So do not stop saving just because they're not matching because you'll end up hurting yourself. And that's just my own personal opinion.
I very much agree with that. That's such a great point. The more you can put away, the more benefit you're doing for yourself. Um, and you're only just helping build yourself up for your
Yeah,
retirement.
you
Now,
are.
as you're doing so, and you're putting that money away and you're using the calculators that Angie set up, a big question then comes next is what happens when you have a shortfall? What do you do at that point when you're looking at I've I've seen what I'm going to get for Social Security. I'm either maybe going to get a pension or not. Maybe I'm going to use an annuity. I'm not sure about that. If we don't have that pillar and I'm looking at what I've saved so far, it's not enough. What can I do? Well, let's talk about your shortfall options because sometimes this happens. And the earlier you know by using calculators from your company's website can help you plan for that. Now, I'd say the first thing you want to consider here is spending a little less during your retirement, right? Looking at your budget and where your budget is going to fall for retirement. Consider if there were plans to make adjustments to your budget or spending needs that you had to adjust those so then you can have more of your money going to what you want to do rather than maybe obligations. So then that's taken care of or trying to just cut back on some of the spending now so then you can do some of the things you want to do in retirement. So you're being more proactive today. And if you end up having to spend less in retirement because you're wanting to retire at a certain point of time, then that's what it's just going to be that you're going to reduce some of your spending on those years. The next one, when we talk about delaying your retirement. Now, I will say this might not be a fun one for many of us because we're asking you to work longer. And I remember looking at when we asked the poll question, what do you want to do in retirement? Someone put not working. I get it. I get it. Same here, right? I love what I do, but retirement time, I don't want to work. But for some of us, we may have to delay when we want to retire. Let's say we were going to retire at 62 to start collecting Social Security, but we see there's a shortfall. Maybe waiting until your full retirement or even age 70. What that does for you, one, of course, it grows your Social Security, but for your retirement accounts, you're giving yourself more years to put money away. So those slow increases you make throughout your life with increasing your contributions, you're giving yourself more time to do that. You're also giving your money more time to be invested for you in those years to get potentially higher investment returns. And then on the flip side, because you have more accumulation years, there's a shorter distribution period where you're collecting your money that you'll be receiving from your savings accounts that you're putting money away to do that. You've postponed those Social Security benefits so you'll get a higher amount on a monthly basis to help you enjoy what you're going to do with your retirement year. And a big one, I think the last one is probably the biggest point is the longer you work, especially for those who are going to retire early, and Angela made a good point about this earlier. Those who want to retire early, healthcare and Medicare is a big thing you want to think about. So if you were going to retire before 62, or excuse me, before 65, you then have to figure out what am I going to do about my healthcare, right? You have to go out there and look for health insurance. But if you delayed that till at least 65 or later, you know you would have healthcare coverage available for you through work. So that's a really big one to keep in mind. From there, the next one we want to talk about is still talking about looking at working during retirement. Now, you may switch jobs. You might go from full time to part time, or maybe there's something that you enjoy doing in your community that could be like part time work, but then you're still earning a little bit of money. What that does, it reduces the demands from your personal savings when you're trying to fill that gap there. And even if it's a little bit that you're getting that helps you get some money, is great. It might also help you still get potential to healthcare that could help cover things that maybe Medicare isn't covering. Let's say the Medicare service you get might not cover vision, dental, and hearing, but work, even though you're working part time, will allow you to put some money towards those particular things. So you can play with that as well. Now, the next point here says the effect on Social Security. If you retire prior to your full retirement age, we talked about there's that reduction when you start collecting at 62. Now, there's an additional deduction that will take place, which is known as an income reduction, if you retire prior to your full retirement age. Now, once you reach your full retirement age, 66 or 67, that goes away. But prior to that, you would see a small reduction in your payment. So maybe that's another thing to work until at least your full retirement benefit. And then some non-financial benefits is you still get to be physically and actively engaged in the workforce. Keep that mind active, being social with your coworkers. Hopefully you enjoy your coworkers. I know I certainly do. It's wonderful working with Angela that you get to still, incorporate yourself in your day-to-day things in life. And what we're seeing with work nowadays, or just jobs out there, they're having phased retirement programs. And these are becoming more popular, where you'll see folks go from full time to part time, or they'll start receiving part of their pension benefit until a certain period of time by the time they go into retirement. Or you can continue working part time so you can keep those health benefits to make sure things are covered. So, check with your job and see where are some of those potential benefits that you can still keep going for you in retirement years, but then going part-time so you're still get to enjoy your retirement years, travel. There was someone who said ride horses, which please can I join you on that, to have a fun retirement, because that sounds amazing. And then lastly, looking at additional other resources you can have, which we'll talk about here in the next slide, is you can potentially look at your home. For those of you who might be planning to downsize the family home in retirement or relocate, getting the cash from the home that you've lived in for so many years, that can be part of your income in retirement. Or if you have life insurance products out there that they provide you some sort of cash value benefit, that you can slowly take money out of those in now or even in retirement. If you haven't gotten one, maybe consider a life insurance option that you can pay into, that in retirement some of that cash value you'll be taking some out, even if it still has like a death benefit attached to it. And then you can help build that retirement. And so, because at the end of everything we're talking about here, we want you to have a retirement that's fun. We want you to enjoy yourselves. And with that, let's see what other questions are out there. Maybe even Angela, you can talk about resources that we have for them too.
I do. I want to talk about resources, but before I do, I want to answer a couple of questions. And somebody brought up HSAs. If your employer offers an HSA, you can qualify to participate in that HSA, but I think you have to be in the higher PPO,
Oh,
one
high
of the higher,
deductible plan.
yeah, the high deductible plan in order for you
Yep.
to participate in an HSA. And a lot of people are using HSAs as another way of saving for retirement. And HSAs offers the triple taxation. Money goes in pre-tax, and if you take your money out, it is tax-free for medical expenses now, medical expenses now, and medical expenses into your retirement. So a lot of people are using HSAs for that reason. So please participate in those. I know you answered a lot of questions during your segment that talked about if I work past, if I'm full retirement age of, let's say, 67 to 70, and I
Mm.
work, it does not affect my Social Security. And the answer is yes, it does not affect your Social Security benefit at all. So a lot of people are working past full retirement age until like their mid 70s, and they're earning quite a bit because Social Security is not affected, and they're earning income, and they're being socialized, so it's a win-win for everybody.
Yeah.
So yeah, so keep that in mind. And let's see if there are any other questions coming in. I don't see any new ones, but I want to talk about your resources, everybody. Okay. Now, we talked a lot today about the most important topic, which is your retirement and the steps that can help you enhance your financial life one day at a time. Remember, as women, we have challenges, but we just gave you some tidbits on how to overcome them. Remember that retirement is long, and so you have to plan for that. A lot of part of your retirement years are going to be spent alone because you are going to perhaps outlive your spouse. Know your income sources. Look at the Social Security statement. Get that, log into that website, get that statement out to know how much to expect from Social Security. Know your retirement plan offered through work inside and out. Look at all those tools and resources and save as much as you can into that plan. Get educated. If there are classes that are being offered to you, don't be shy. Knowledge is power. So learn as much as you can about finances and taking the reins there. For questions, of course, we welcome all the questions. And if you can reach out to us and speak with us, we would love it. You can email us at helpdesk@mywealthsense.com and you can schedule an appointment with one of us, right? We're here to help. And with that, let's see if there are any other questions. And Diana, help me look and see if there are
Yeah,
any questions that we can
absolutely.
answer.
Absolutely. There was a question that came in from Amanda and it asked, is there a cap on how much you can take out from your 401k in retirement?
And the answer is no. Once you get to your retirement years, once you get to the distribution age of your 401k, whether it is 59 and a half, whether it is you terminate employment, right? Whether you get to your retirement years and you're working, there's no limit. However, be cautious because if you take a distribution and that distribution happens to be from your pre-tax, right? And so now you have Social Security, you're earning income from work. Now you're taking a lot of money out of your 401k. That's going to bring you to a higher tax bracket. So just be mindful, speak to your tax consultant to make sure that you are not paying higher taxes because you're taking out too much. I hope that answers that question.
Yeah, I would agree with that. And I'll take this next one here. It asks, what happens to my HSA account if I switch away from a high deductible plan? It'll still exist. The account is still there for you. You won't be able to make contributions if you go to the PPO or the HMO available at work. I actually did this myself, that I'm currently in the PPO because I just have some medical needs I need to take care of. And it was more beneficial for me to switch on over, but my HSA is still in there. You can invest some of the money in your HSA. You'll have a simple list of investments available to you. That keeps happening and growing for you while you're out of it. If you then, let's say next year, decide to go back into the high deductible plan, you can then make contributions next year and keep going from that. So you can play around with that. Earlier I saw, I'm going to go back to a little bit further back, there were some questions about Social Security, asking what happens, or are there any limitations if my spouse was to, if we got a divorce and let's say my spouse passed away, were there any be limitations on Social Security? And I would say not necessarily limitations, more qualifications for those who are going to receive spousal benefits, survivor's benefits, or anything from your previous spouse, current spouse. There are qualifications that you have to meet rather than limitations. When you go onto the Social Security website, there's a benefits section that breaks down spousal benefits, survivor benefits, family benefits for kids, and it'll tell you what the qualifications are, potentially how much you could receive on a percentage basis, so you can keep that in mind if you need to plan for that right now. First, because it looks like some of the questions are more present facing. If you need to do that now, you certainly can. So then you know what you need to do to get some of that benefit that might be available to you.
And I do have another question about contributing to a non-employer Roth. So a Roth IRA, there are
Mhm.
salary limits that will govern how, whether you can contribute to a Roth or not. And if I'm not mistaken, I think it's $150,000. But again, you can find that information when you do try to open up an IRA, or on the website that you're contributing to an IRA. It's going to tell you about what those income limits are. So keep an eye on that. Another question is, what happens if I pass away? Who's going to get my 401k? Your beneficiaries. And that is a very important point. Okay. Retirement accounts, IRAs, Roth IRAs, traditional employer 401ks, regular retirement accounts. Those beneficiaries are important. You have to update them on the website for your particular plan. Beneficiaries and retirement accounts bypass any will that you may have. I have a will, Angel. I'm going to leave my money to my son, Chris. Well, if my son Chris is not the beneficiary in my 401k, my son Chris can get the money in my will, but not my 401k money may go to probate. So please update beneficiary designations on the um, retirement plans website. If your employer is one that does forms, well, make sure that your form is accurate. And a couple of rules about beneficiaries in retirement accounts. Your primary beneficiary by law has to be a spouse at 100%. If you're not going to choose your spouse at 100%, the form must be completed and notarized where your spouse is going to authorize you to leave the money to someone else. Good luck with that. That has happened. But it's important that you update beneficiary designations and keep it accurate. If your family situation changes, you update that beneficiary designation.
That's a good point. Your beneficiaries are everything. Naming someone on all of your accounts, not just the retirement accounts, bank accounts, taxable brokerage accounts, are is the first, easiest, most effective way you can look at estate planning. So please, please do that. There's a question asking, are Social Security benefits taxable? Yes, unfortunately, they are, but they're taxable up to a certain limit and how you file. And of course, that makes things, of course, more complicated. But depending if you're filing single compared to married filing jointly, will depend. And then your income level on SSA.gov, there's a section about taxes, or IRS.gov. You can type in Social Security being taxed, and they'll break down how much that looks like for you. So then you know what could potentially be taxed. And it's not, it's there, they have a combined income that takes like half of your Social Security benefits, so it's not all of it. How much non-interest or non-taxable interest you're getting, as well. So it's a combined number that would look to see what will be taxed on your benefit at that point in time.
And I want to answer something else, another question that came up. And thank you for that, Diana. And this is about survivor benefits. Survivor benefits is if you have young children and their dad passed away, there may be an entitlement to survivor benefits. And where do I find that? Please call the Social Security Administration.gov website to get more information on those survivor benefits. That's exactly what it means. Also, if their dad had a 401k plan with their employer, it doesn't hurt to go call that previous employer and say, hey, um, if that spouse didn't, if the person that passed away didn't already remarried, keep that in mind, because remember with marriages, the primary beneficiary becomes that spouse. So something to look into if you know that the kid's father who passed away was maybe single, something to look at employer retirement accounts, but certainly Social Security Administration to get that survival benefit to see if it is applicable to them.
Yeah, and folks, we are at time, top of the hour. Again, thank you so much for being here. Don't forget to scan the QR code for our survey. And for those who need it, the passcode is Strong Women. Thank you, thank you, thank you all for joining us today. We had a wonderful time with you all. Thank you again for coming and for your
Thank you
questions.
very much, everybody. Thank you, Diana, for your partnership. Have a good
Yeah,
day.
thank you. Bye bye.